Mythili to take her first view on the same. Mythili, your takeaway from the RBI governor speech?
Well, the rate hike was, entirely along expected lines, but as far as the stance is concerned, I think there was a case to move to a neutral stance simply because liquidity is tightening, growth is slowing. So the growth inflation trade-off should have perhaps been tilted a little bit more, in a more nuanced fashion. The RBI does remain focused on inflation control, which is right, but perhaps they could have done that because as far as liquidity is concerned, we are going to see substantial tightening, not just because the government is borrowing more, but also because you are seeing that there will be a risk off as far as emerging markets is concerned, and you will see banks giving more by way of credit. So for a variety of reasons, liquidity is going to be a little tight, and a neutral stance would not have mattered at all because you could always move either way. A neutral stance means that you can tighten as much, prospects of tightening as much as prospects of easing. So I thought there was a clear case for a neutral stance, which is perhaps why we've seen a divergence of opinion, a 4-2 verdict both on stance as well as on the repo rate. That is something, a considerable difference from what it used to be in the past.
We also have Nilesh Shah as always joining us to talk to us about the policy action. Nilesh, hi, good morning. What's your takeaway from the RBI speech? It feels like the banks are not reacting quite positively. We are seeing a bit of a slip there.
So this policy is as per the expectations of the market, and I will call it a insurance policy. RBI had the choice of raising rates or not raising rates. Both would have been acceptable, but they preferred to err on the side of caution and raised rates by 25 basis points. And as Mythili mentioned, they could have probably made the stance more neutral, more nuanced towards growth, but they are taking it based on the data coming through. Going forward for the market, the real challenge is government's borrowing program. While in absolute number, borrowing program is similar to current year, next year, the liquidity is getting tightened, as Mythili mentioned. Now, we believe without RBI's active involvement, this borrowing program could have impact on yields. So it will be interesting to see how RBI conducts its open market operations and their assurance in this policy that they will conduct operations on both sides of the left may be a step in the right direction. So more than the monetary policy, now markets will be more focused on what is the first up borrowing program and what kind of involvement RBI will do, including open market operation, to ensure that borrowing program passes smoothly.
Also joined by Sachidanand Shukla, Chief Economist at Mahindra & Mahindra. So let me just ask you for your first take, Sachidanand, and then we can move into the more granulated view of the policy. So for your first take, do you agree with Nilesh? And for a change, Nilesh, you agree with me. That's quite a novelty. That's also a first, I think, as far as policy commentary is concerned from panelists. So over to you, Sachidanand.
So I think this is exactly what the doctor ordered. I completely agree with Nilesh Bhai. This is more an insurance policy. We need to remember that in the backdrop, the four big brothers, the Fed, the ECB, and all these biggies, they continue to raise rates. So while they're moderating the quantum of hikes, they will continue to raise rates and at least 50 bips from here on. And I think the very important point to note here is, Mythili, if you look at the persistence of core inflation, it is not yet time to declare victory. And I think this is more of an insurance policy in the backdrop of the globe. And also domestically, the persistence of core inflation, it's almost 3 years now, and core inflation has really persisted. While the budget has really been non-inflationary in the sense, this is for the first time we are seeing revenue expenditure being cut by nearly 4% in an electorally sensitive year. So we have very little degrees of freedom if something were to go wrong going forward. But I think the thing that they have done on the stance as well, I think this is exactly what the doctor ordered. We don't want to be signaling victory over inflation as of yet. We don't want to be taking our eyes off the global risks or domestic risks. And we don't want to be undoing whatever we have achieved by way of the past rate hikes and the stance that we have had. So I think this is a very, very, say, positive policy in that sense. One thing, Mythili, that I notice is if you look at the growth numbers that the RBI has come out with, they have actually cut the first and second quarter numbers significantly. So just to give you the numbers, I mean, first quarter, they were earlier saying will grow at 7.8. They're now saying it will be 7.1. And Q2, they were earlier forecasting a 6.2. Now they are forecasting 5.9. So I think there is a significant moderation in first half growth that they're looking at. So back to you, Mythili.
Okay, so I think Sachidanda doesn't agree with us as far as the stance is concerned, but he does agree with us broadly on the other two fronts. But Nilesh, precisely because of what Sachidanda ended with, that growth in the first half of next year is expected to slow, would you think that really strengthened the case for a neutral policy stance? That is my first. And my second question to Nilesh is that how much of a difference will this make, the policy announcement of a facility for lending and borrowing G-SECs? Will it really make a substantial difference to liquidity? As far as my understanding of G-SECs market is concerned, there is enough liquidity in certain securities and there is virtually no liquidity in certain others. So it is not as if there's a one uniform definition for liquidity in G-SECs, but you're the expert, so please correct me if I'm wrong.
Today is the day where I'm agreeing with you, which is quite opposite to our past tradition. But on a serious note, I think RBI is taking a stance that if growth is suffering, we can always cut interest rates very, very quickly to support growth. But if core inflation and headline inflation does not come under control and remain sticky, then we'll have to raise interest rates far more. So might as well err on the side of caution, do a 25 basis point increase and wait for that impact, including the past interest rate hikes on inflation, and see if the actual trajectory of inflation goes below 5.3%, which is what they have projected for FY24. In some sense, past interest rate hikes seems to be working, as the fourth quarter inflation number has been revised downwards. So hopefully RBI is erring on the side of caution, gives them the elbow room to support growth when needed, and yet bring down the inflation under control. From a liquidity point of view also, it is a kind of insurance policy. It assures banks that government securities, which may not be easily tradable without impact costs in the market, you can still access liquidity from RBI window. So this is more preparing for the FY24, where liquidity is likely to be tighter for the reasons which you explained earlier.
I can just supplement this, the window that you say of borrowing and lending, if it's vis-a-vis the RBI, then how much of a fair price determination, market discovery process will you have as far as the pricing is concerned? Or will you have to buy at RBI dictated prices and rates?
You have the final aces in this game. They can use that to give price signal. They can use that to give price discovery to the market. And many a times we have seen that one arbit trade kind of creates the price level in that security. However, when you go for an auction kind of mechanism, then you realize that the price discovery for a larger quantum is totally different. And this is true especially at the long end, where one or two trades, on a pure arbit basis, raises or lowers yield, but the auction yield, primary auction yield, is substantially different from secondary market yield. So RBI will be able to use this mechanism on both the sides, price discovery as well as price signaling.
Okay, so we've also joined by Ashwini Tiwari and Ashutosh Sudaria. Welcome so much to this discussion. Ashutosh, if I start with you, what is your first take? Since both the other panelists have given me their first take, so let me first give you a chance to give me your first take, and then perhaps we'll move on to a little bit later. Ashwini, I'll come back to you later. Ashutosh, I'll come back to you later. Ashwini, you go first.
So this policy again is on expected lines. Our in-house economist was on record saying that this could be the final hike. But of course, we have heard the governor say that this, whatever it takes, the inflation has to be kept in control. And to that extent, even though some of us were thinking that it has now come within that band of 2 to 6%, but still, I think as some of the earlier speakers have said, to just kill the beast in a way, I think that is the objective. However, having said that, from a banker's perspective, we haven't seen any shortfall or any de-acceleration in the credit growth across sectors, not only the corporate side, which has come to us in a big way now for the last 2 quarters. But also for the retail side, we continue to see very strong growth. So while the increase in EMIs surely will hurt over a period of time, but I think so far the growth numbers do not show that. So the policy is on expected lines, and hopefully the other parameters, other things which have been told by the governor in terms of the climate norms and those things, those will be very useful, and we are very interested. We're having those conversations. Hopefully those will be the areas where we will interact more. The interest rates, though they impact us and our customers, I think the discussion around that is best left to the economists who are more qualified than we are.
Action right now is coming in for the Bank Nifty, which has slipped over 300 points from the highest point of the trading session. So let me go across to the banker as well. Ashutosh Khajuria, the Executive Director at Federal Bank, is joining us now. Mr. Khajuria, anything that is disappointing you from the commentary that might have led to a bit of a negative reaction on the Nifty Bank? And also, secondly, with respect to the assumption on the street that this is going to be the last rate hike, do you concur with that view?
So I think 25 basis points hike was more or less, in line with what the market's expectation had been. I think, the house was little divided because there was a group which thought that we can have a pause now and see the impact of rate hikes, and thereafter wait for another action if required, if warranted. But I think MPC decided to go ahead. Citing the reason that the core inflation is intransigent and it needs to be reined in, and for that matter, because consistently had been above 5% or so, and this was a call. But I think in MPC also we see a 4-2 verdict. So it seems like I think gradually the thought process in MPC may go towards a pausing and waiting for the outcomes to be properly analyzed and all. It has to be data driven. There are so many risks like oil prices and all, that's commodity prices all included. But looking into the favorable so-called reservoir level and agricultural output projections, more land under cultivation, also a mass so-called workforce of the country, for at least in the context of our country. I think despite having 15% share in GDP, I think the dependence is to the extent of 55%, and there if the outcome there is good, the prices are under control, I'm quite hopeful. I think we are moving towards pause. So this could be a terminal rate in the recent cycle.
Okay, that point is taken. Ashwini, let me come back to you and talk to you about the announcements that the governor has made. And just wanted to get a sense from you with respect to the liquidity position. He still said that it continues to be in surplus, and that's why they haven't changed the stance when it comes to from withdrawal of accommodation at the moment. What's your reading of how the liquidity is on the ground, and with the latest measures coming in with respect to the lending and borrowing of G6, how do you expect it to trend?
The lending and borrowing has been commented on, but in general, I would say that the government always talks about the overall liquidity which is there in the system. As far as we are concerned, because of the strong credit growth in the last 2 quarters, and as everybody is aware that on an overall basis, the loan growth has been higher than the deposit growth in absolute numbers as well. So that clearly has put a pressure on the liquidity as far as the deposit growth is concerned. And therefore, we see these rates, deposit rates go up. And while that is good for the savers and was long overdue, if this trend continues, and so far in the current quarter also we see a strong loan growth, I think if this trend continues, then there will be some pressure in terms of providing for those loans, and we have to also provide on the mandatory ratios of SLR, CRR on the deposits which are raised. So therefore, the cost will go up, and also there is a scramble for deposits. So hopefully, the liquidity conditions overall will help us, and the RBI has been saying that whenever the banks require, there are windows available with RBI and otherwise, so banks can access those. We still have some surplus SLR, but the positioning is reducing by the day. So hopefully, going forward, the liquidity will allow us to fund loans at a affordable cost. That is the key word in this whole scenario.
Well, Thank you, Ashwini. I know you're a busy man, so we'll allow you to leave us at the moment. But thank you very much for joining us. Let me now move to ask Nilesh a question which I think is very, very much up his street. Nilesh, as far as yields are concerned, how worried are you about yields moving up and quite sharply, because we're going to see a decline from insurance companies, from mutual funds, and the fact is that the government's actual borrowing is likely to go up, even though the government has said 5.9% of GDP. The fact is that you're not going to get the support from tax revenues that you had in the past. You're not going to get that nominal bump up as far as GDP is concerned. So for a variety of reasons, and you now don't have the advantage that small savers had vis-a-vis bank deposits. Now, bank have been increasing their deposit rates quite sharply. So the support that you could get from small savings is likely to kind of come down, if not entirely disappear. So how much of a pressure do you expect to see on yields? Will it cross that 7.4? Will you move up to 7.5, maybe 7.6 as well, Nilesh?
So yields are really, will require RBI support. For all the reasons you mentioned, clearly there will be upward pressure on yield. And the only thing which can contain yield, one could be that this is probably one of the last rate hike and inflation is coming down. Real interest rate will be positive for India in FY24 against 6.5 repo and 5.3 expected inflation. 1.2% real interest rate is not bad. And we may see some support coming in for yields at the end of 2023, beginning of 24, if globally interest rate cycle gets reversed. But undoubtedly, market will be looking forward to RBI's participation. They will look forward to RBI's verbal signaling that this is Lakshman Rekha, don't cross yields above this. They'll be looking forward to open market operations to give price signal or to absorb excess government supply. In our opinion, RBI will have to probably intervene to the extent of anywhere between 10 to 15% of the government's net borrowing program next year, so that yields don't cross the Lakshman Rekha.
Okay, let's see whether the yields cross the Lakshman Rekha or not. But yes, there will be an upward pressure on that. On that note, we'll wrap up the special coverage of the RBI monetary policy decision. Mythili, as well as Nilesh, Sachidanand, as well as Mr. Ashutosh Khajuria. Thank you so much for joining us. So that's the verdict coming in, 25 basis point hike with no change in stance of accommodation. But the market is not taking it too well. The